What's the difference between term and permanent life insurance?
It's a great question. Okay, so think about renting a house. Since we're on real estate radio, think about renting a house or an apartment versus buying a house or an apartment. So with term insurance, you're buying a death benefit for a defined period of time. Okay, you got a roof over your head, but you have no equity in that term policy. Okay, so if you buy a 20-year or a 30-year term, once it's up, it's up. Okay, so term insurance is designed to basically, actuarially speaking, never pay out. Roughly 2% of all term policies actually pay out. Okay, because statistically speaking, you're going to live far beyond, the 20 or 30 years that you buy the term policy. So term insurance can be a really good thing. If you're young, it's cheap, and you have a temporary need. Let's say we talked about the kids going to college. Okay, I want to make sure I got $500,000 so I can pay off most of my mortgage and make sure that my kids get through college. But after that, that need kind of could potentially go away. So that might be a need for term insurance. Okay, there's some advantages to that. It's the least expensive in your younger years. Again, you only pay for a limited time. One thing you can do is that many of these policies, or most of the policies, are convertible. And I'm not sure if you know what the convertibility option is with a term policy, but what it allows you to do is that, let's say, Todd, you get a policy and you're young and healthy and you're a non-smoker, and so you have a very good underwriting class. Time goes by and you come down with a terminal disease. I'm just giving you an extreme example. And so obviously, if you went out to get a new policy, it would be you would either be uninsurable or the premiums would be really high. So the convertibility allows you to convert your term policy to a permanent life insurance policy based on the underwriting that your policy was issued. So that's a really neat feature. And also, you're probably aware of different riders that you can add to these policies. The accelerated benefit riders. Their traditional accelerated benefit says, so Todd, if your doctor says you have 12 months or less to live, then you can tap into a percentage of your policy and use that money while you're alive before waiting for you to pass away to have that money go to your spouse. And so they've kind of broadened those definitions of these accelerated benefits to chronic and critical illness. And so they're trying to cover some of that long-term care need to an extent.
So what happens if you have a terminal illness, you cash out, and then you end up surviving? Do you have to give it back?
Chances are you're not going to survive. I mean, literally, the doctor says, Todd, you have 12 months less to live. And so how that works is, let's say you had a $100,000 policy and you took out $50,000 and then you passed away. Your beneficiaries would take that $100,000 minus the $50,000 and they would get the net amount of that.
Well, what are the disadvantages?
The disadvantage is that term insurance is very expensive when you get older, and once you turn age 50, it's very hard. You can buy a 30-year term policy when you hit 50, but once you hit age 51, it's hard to find. So it's hard to find a term policy that goes out, past age 80 roughly. There's no cash value. Okay, so if you miss your premium and you can't afford it, you go into a 30-day lapse period, and then boom, it's done. And so you don't have that cushion like you would in a permanent coverage, which kind of gets me to the difference between a permanent life insurance policy. Okay, so we just talked about term. We also have permanent, which is your traditional whole life, your universal and variable universal, and there's also an equity indexed UL. What the permanent coverage does is that it takes the variable of when you're going to die out of the equation. Okay, so if I knew that when Jim Musgrave, was going to die, I would tell you what kind of policy I should own, right? If it's within 30 years, I'll buy a 30-year term policy. But I don't know when I'm going to die. And so I want to take that variable out of the equation. So most policies will be guaranteed age 100. They can go up to 120, okay? So that gets you beyond that bell curve. So essentially what a permanent policy does is that it actually, you're pre-funding the expensive insurance down the road. You're kind of front-ending it. So you have the cost of insurance and you have your premiums, which are a little higher than that, and that actually builds in this cash value.
Okay, I think we're getting into the realm of this is when they have to sit down with you and go over the different options. But the two most popular ones that I know that are out there, and correct me if I'm wrong, is the term insurance, term life insurance, and the other most popular is whole life.
Yep.
Let's talk a little bit about whole life.
The main advantage of the whole life policy is that most whole life policies will actually generate a dividend. And that dividend can be used either by additional life insurance or it could be used to pay down that premium. So the premiums of whole life policies tend to be a little higher than universal life, but with that extra premium, that cash value really, really builds. And you get to a point where that cash value gets to a high level and the actual death benefit starts to increase as well. So you can use what we call those PUAs or paid up additions to actually pay for the premium. So you could conceivably have enough cash value in the policy that's generating enough dividends to actually pay for the premiums. So which is a pretty cool thing.
So let's say I come into an inheritance.
Okay.
I can just do a lump sum and pay into like a whole life policy, or do I just have to? What are some strategies that people are using whole life policies for?
Whole life policies are generally used, again, for the permanent coverage. They're used, again, when you have cash value in your life insurance policy, you can take loans and withdrawals out on that, and you can use it to pay for college, retirement, or just take money out to spend for whatever, okay? So those are some, big advantages of that. And again, as I mentioned in the last segment, companies can use those to fund non-qualified deferred comp plans, and those sorts of things as well. But anyway, so the cash value can be a very, very powerful tool.